So we're recapping our Kentucky deal. We had a lot of nuances going out of our current market and getting into a syndication deal. And we learned a lot of really great stuff. I think the first thing was going back to the contract. We have a really good team in place, and the contract for this was out of state, so all of our deals typically have been done in Tennessee. So there were some nuances there. We were able to work through it. We were able to retain our current attorney. But that's where the rub came in with some of the vendors, because as we were going through the process, we had to find a new group to snake our lines for plumbing. We were fortunately able to use our current inspection crew because we do a lot of it in-house, but we also have another inspector that assists with it, so we were able to carry that over. One of the things that was a big difference for us was the survey, though. We have a really great surveyor locally, really affordable prices, but there's some things going on there where we cut out a piece of land because we knew there's a lot of value there and we weren't going to build on it, and we were able to sell that. So there's a lot of little different things going into this deal, and we just want to recap those for you.
Overall, I think that those are the two biggest nuances that really have changed the dynamics of this deal versus the rest of the portfolio, right? Because currently the existing portfolio is all in Knoxville, right? And over time, you really build some strong relationships with the different vendors that allow you to make sure you have your go-to guys, right? You have your 2 or 3 guys in the area that are your go-to guys. So having it in a different market for the first time was number one. And then number 2 was the fact that we're actually syndicating this deal, which means that we're bringing on outside investors for the first time, opening up the doors for outside investors to partner with us on the deal. So we had about a little over 30 different partners on this deal that are investing alongside us. So amidst the closing process, again, it's standard 60 days to close. Amidst all of the typical due diligence and inspection items and making sure that we're prepared as possible for closing, we also had the raise taking place. So we're going to share with you some of the highlights and some of the learning lessons that took place during that first raise.
One of the really interesting things was that we were talking about the struggle of going into a new market and working with new vendors. But that work is done now. So we've actually added some really great folks onto our team. So the next deal that we do in the Louisville market, it's going to be much easier because we already have an infrastructure in place. We're starting to build on those teams. So it's that initial thrust that's always the hardest, being an entrepreneur. But after you've established yourself and you've become embedded into a market, it becomes a lot easier. So we're super excited about that. The other thing is the inspection went really great. The properties are very well cared for. It's brick, newer roofs. Going to have some paving work to done. We've set that aside in CapEx. But overall, just a mom and pop that needs a little bit of TLC and needs some market bumps, actually. That's one of the biggest things, that they're so far below market because they only raised $5 per year. Next year you're going to go up $5. Well, the thing that mom and pops didn't realize is that they're not keeping up with inflation and they're not keeping up with the market and they're lagging well behind. The interesting thing is that you actually attract a different clientele and a different group of residents because they think, well, this is a lower cost property and maybe there's something going on there. So as you're able to actually increase the customer service and actually increase the pricing, you actually can attract more qualified tenants over time too, which is an interesting thing we've seen in a lot of our deals.
And you have the extra capital set aside to reinvest back into the property, right? So not only does it not raise a flag when someone's looking at it online, why is this one only $500 versus the rest of the market, say $700, right? That can raise a flag for some tenants that are shopping. And then also, if you're using the bare minimum rents to just pay your mortgage, you're left over with very little to keep on reinvesting and making sure the property is up to date. So again, it's providing a higher quality living for the residents as we continue to make it a more profitable venture for us and the investors at the same time.
I want to dive into the raise a little bit because Dylan did a great job over time of working with the different investors that are in the group and educating them and bringing them up to speed on sort of our model that we've proven over time. And it was really incredible because we basically got our commitments for $2 million completed within 48 hours, right? It was 2 days.
48 hours,
roughly 48 hours. So you want to talk a little bit about the process that you went through in terms of getting folks ramped up and then the model of, going from, hey, we got a group of investors here, now we have a deal in the pipeline, and how that conversion took place.
Yeah. So there's a couple key points here. Number one is that the deal sells itself, right? When you actually take your time and are patient and persistent in finding the right opportunities, that in itself is going to help you with the raise, right? If you're trying to sell a deal and really convince people why they should invest in a deal, then there's probably something going on there, right? So I think number one, it was the fact that we were very patient in waiting to find the right property to offer to our investor base, because that's going to help us establish a good trust and good confidence with the investor base that, again, we're selective about our deals and really looking for the ones that fit our criteria, and we're willing to walk away every single time when it doesn't fit our criteria, right? So starting off, the deal is always the first part. Second part is the work that takes place prior to it, right? It's a typical Muhammad Ali quote, right? The stuff that they don't see is the thousands of hours before getting underneath the bright lights and going into the ring, right? And that's what took place with the Rays, was that we spent it was about 4 or 5 months of constantly working and constantly, not only did we have a CRM and investors opting into our CRM, but we were going the extra mile and actually having intro conversations, a lot of them going up to 30 minutes long, where we would actually explain to our investors what our criteria are. This is what we look for in an investor, and this is what we look for in our deals. And then we set these standards up front, and then we sent them monthly email updates to keep them updated with what we're doing along the way. And then we followed through and delivered on our end exactly what we said we're going to deliver, right? We told them we look for workforce housing. We told them we look for, a lot of times, mom and pop style apartments, and we do light value adds. And then the product that we present is completely congruent with all the expectations that were set. So I think that helped us big time with the investors. And I think that the 48 hours looks like a very short window, but not only did we have 4 or 5 months of actually having 30-minute conversations with everyone, but then again, you also have the podcast that's been going on for, let's say, 5 years now, right? Which has really been developing strong relationships. So by the time we're actually connecting with these people, they feel like they know us, they trust us, they have the relationship. So I think that's the first thing, is just breaking through the obscurity that can come from it when you don't have an existing audience and you're jumping on the phone for the first time with these people. If someone's just meeting you, it's just like dating, right? You're not going to go and ask someone to marry you, right? The first time you meet them on the street, right? It's you want to slowly develop that relationship long before the deal hits your plate. So I think the big learning lesson for anyone that's interested in starting to syndicate and starting to partner with outside investors, I would say just keep it in mind that you should always be marketing, always be taking your time to build these relationships, because when the deal comes, the last thing you want is to scramble and try to figure that out last minute. So.
And it's done through hard work, countless live events, countless phone calls, countless podcasts. And then you have to deliver the goods, though. And that's what we came through with this deal, is that we like the market. We want to be in the market for the long term. We like the price per door. It's a good value. It's well below market, so we really love the deal. We were very selective on the deal. And we have the right debt in place. Phenomenal debt on this deal. It's 10 years fixed. Freddie Mac, 30-year amortization, and where are we at? 458 on it?
Yeah, I think at the time it was at 140 point spread.
Yeah, this is the kind of stuff that's very challenging, that only comes with long-term relationships and doing a lot of deals. So we did, just box after box was checked on this, which is going to make it a great investment for years to come. So it was a challenging takeover. Even the day of closing, Dylan and I went up to Kentucky, and there was some issues because there was a storm and signatures being shipped around. So every time you do a deal, it's always going to have its challenges, but we were able to persist. We pushed through, and now we're starting to see the fruits of our labor. We have the land listed that we talked about. We've carved out 4 acres that we have listed right now for about $300,000. We're cleaning out one of the storage sheds that we're going to put on the market and actually get another commercial rental out of it. We're implementing rubs. We've actually implemented a $3 pest rub where we're billing the tenants back, for the pest services. We've leased 2 of the units out at market rate. So we're hitting the market, we're adding the rubs to it, and we don't have any availability yet. And now we're starting to send renewal letters out to buildings in order to get those other folks up to market rent. So within a year, this is going to be a very quick turnaround. We're getting our signage in place right now. A lot of great things going on. Going to work in the spring by getting our dog park. Everything that we've talked about up to this point is starting to actually take shape. We've redone the office a little bit. So it's really great to see all this work that went up to this point is now starting to get pulled through.
So I'm going to pull up my calculator for a second here, because I want to talk about the amount of value that we've created just through thinking outside of the box, right? Because you can go in here and you can follow a cookie cutter format of just go in and increase the existing rents and leave it at that. But I think our team took a very high level view of the property and really looked at how can we create additional value. So on the low end, right, we have the land listed right now. The land we expect that will probably sell for $200,000 to $300,000, right? So that in itself, we could have easily overlooked that and put that under the same contract as the rest of the property and had debt sitting on that land. So once we closed, we could no longer sell it, and we completely missed out on a couple $100,000. Then we had 2 commercial units, so that the leasing office is a larger office that actually has 2 gigantic garages there that can serve as sort of industrial commercial style units that can be rented out by various blue collar businesses. So that in itself, we expect to see at least $600 in rent per month. So that gives us $1,200 per month. Over 12 months, that's an extra $14,000. So not only are you getting an extra $14,000 per year, you hold that for 10 years, that's another $140,000. So now we have $140,000 plus the additional, on the low side, $200,000. So we're at $340,000 in value, up $340 to $440, depending on what the land sells for. But then you're also going to sell that. We'll say we sell it at, we'll even say just a 7 cap. That adds another $205,000 to the value of the property. So now you're at, you go from $340,000 to $540,000 because you're selling the property for more because you have a higher income because of the commercial units now being rented out instead of us just using them as an extension to the leasing office. And then you also have some additional fee income, right? So you're also adding, might be another 10% via the fee income. And that not only does that help us during the cash flow, but it also is going to help us at the sale of the property. So if you actually add up every single thing that we've done so far to add value to the property, you're probably looking at close to $1 million in just value creation. Whereas if we did not think outside the box and if we just simply let the property do what I'd say 8 out of 10 people are going to go ahead and do, we'd be left in a position where we're missing out on up to 7 figures of opportunity.
And we rolled the dice because we had to literally carve out that piece of land as we were going through the closing period. So we had a limited amount of time to make sure the town was going to approve it, the surveyor had their work done, and if we would have got it done in time, we would actually impacted our loan, and we could have got a much higher rate than what we originally had agreed to. So it really was a gamble to a certain extent, but it was a calculated gamble. So we were able to do that. We pulled it through. Fortunately, it worked out, and now we're going to be able to create value because we took a calculated risk. So all in all, huge success. We were able to go into a new market, set up shop, cut the land out, get it listed, and implement all the value add strategies that we've used time and time again in our backyard. This gives us the great scalability to now go into further markets, duplicate the process because we've seen it work here, and we're going to continue to do it on, and create new investment opportunities for our investors.
It all goes back to, right, if it's worth doing it once, it's worth doing it again and again and again, right? And that's how we think about the markets that we're moving into. When we're moving into a market, whether it be in Tennessee or Kentucky or Georgia or the Carolinas or anywhere here in the Southeast, anywhere we move into, we plan on building a basin, right? We're planning on building a team, building a foundation, and repeating the process again and again, knowing that each time it's going to build us more economies of scale, it's going to build us a stronger team, and the process will only get easier and more duplicatable. So that's our model, and that's what we're excited about because we know that not only with this property is it going to be a great investment, great deal for us, but at the same time, it's also the first foot in the door to a new market that we plan on doing some great things in.
Yeah, I think it's about expanding our vertical integration and continuously outperforming when we go into these new markets because we understand the model that we're all about and we're able to duplicate it time and time again because we've proven it multiple times already. So we're sticking to what we know and we're just looking to expand our reach.